Hey everyone, Eric here. What if I told you that you could have 472 winning trades, 28 losses, and that strategy is still negatively expected? You would be right. We're talking about another variation of a short DTE SPX strategy. These things are so compelling for a lot of reasons, and there's a ton of different variations. And the punchline is they don't work well, and they work in certain instances, like most trades. But what draws a lot of people to these style of trades is the idea that they're simple, they're short time in the market, they're easily repeatable, there's not a lot of thought involved. And when you realize all of those things sound great, and if it worked really well, I say it all the time, everybody would do it. So there's a reason why everybody doesn't do it. And it's a little touchy, right? Because you don't always want to follow the pack. You know what I mean? Like, definitely need to do your own homework, do your own research, feel comfortable with what you're trading, all those sorts of things. But a lot of times it is important to keep an eye on the pack. And what I mean by that is just all the other traders, right? If there's just a ton of people that are talking about a stock and driving the price up, sometimes we're drawn to that for the wrong reasons. And it's simply because other people are doing it. So it's a little bit of a catch 22. And I think it's important to keep an eye on what other people are doing because same thing in this scenario. If this truly was such a successful strategy, everybody would do it. So the fact that a lot of people don't do it doesn't mean that it doesn't work, but it means that you might need to peel back a few more layers than what might see at the surface level. So let's dive right in. And I apologize up front. There is a little bit of Excel stuff that I'm going to go over in a little bit. My goal is to keep it that part as light as possible, but overall, this is a slightly more quantitative discussion. So again, apologize for that in advance. I try to keep these short, snappy, but this one required a little data aggregation and stuff like that. And I feel like I need to explain some of the assumptions I made and some of the decisions I made with the data because it does mean there are some shortfalls with the data as well. And I think it's important to at least recognize that so that we have an honest discussion about the strategy. So let's take a quick look. Um, I guess I gave an overview to the strategy itself. This is designed to be another high probability short DTE trade in the SPX or an index, really, for that matter. It doesn't have to be the SPX, but most people just gravitate towards that. Um, Unlike some of the other versions of this we've seen before, this one not we're gonna, well, they're gonna or they sell to open 1 to 4 days to expiration SPX short puts. So that part in and of itself, that 1 to 4 days to expiration in the strategy outline, it mentioned that they do it 3 times a week. So essentially, to me, that tells me that we're using, the weekly expirations within the SPX. So instead of, I don't think there's a lot of 4 DTE opportunities in that because another part of the strategy, as it outlined, is you got to take the trade off before you put the next one on. And just another side note, this analysis of somebody else's strategy, this is, just free information on the internet. Actually, one of our friends, our viewers, sent it over to me to take a look at. So I'm being vague about it because I didn't reach out to them about reviewing their strategy. And I'm not taking any credit for the strategy. This is not mine. This is somebody I found off the internet. Um, but they do have a whole website built around this kind of thing. So, anyways, they talk about selling the 5, 6, and 7 delta short puts. And I guess they originally started with the 6, then they realized that didn't work too great, I guess. So then they added the 5 and 7, and I'm surprised they haven't realized that that doesn't work either, but they'll get there. And the idea here is that they set a limit to close at 70% max profit. Losers are held to expiration. So there's a couple things here. The pros I would argue for this strategy is that it is very straightforward. There's a lot of opportunities to deploy it. I like that this variation gets rid of the spread. Most of the strategies you see here talk about it as an SPX, short put spread. And I think that spread really adds a lot of issues potentially, especially because they tend to manage that spread. So, all in all, not a great setup. So, I'm glad to see a little bit of variation here. The downsides to this strategy is the black swan exposure, which I'll get into in a little bit, will kill this whole thing. And it's super misleading because, like I said, the first variation of this, which we'll go over in a minute, but it has 472 winning trades out of a 500 trade pool. I just picked 500. But it has 472 winning trades. That's 94.44% wins and 28 losses. And across that, one black swan event would wipe out the vast majority of the profits. And it's important to keep that in mind. And then the other con here is I said it already, it's market dependent. A lot of people want to use this strategy in most market conditions, and we'll go over why it's just not a good idea. This is still a directional strategy. You still have downside risk. And the fact that we're willing to hold losers to expiration, it increases our overall probabilities of success in the strategy, which is good. But I would argue that closing at 70% max profit is psychotic. I think that that does not help this strategy whatsoever. It's already a really high probability strategy. And by essentially kneecapping yourself and only taking 70% of an already very small max profit is not good. So, in that sentiment, I tried to give the strategy the benefit of the doubt as I looked through it, and I did not apply this. So, it means that we take it to expiration essentially. And the reason for that is the number of intraday reversals that would have prevented is statistically insignificant at best, if at all. So all of that is to be said, that I think this is a huge issue with this strategy. All right, so let's take a quick look at the Excel sheet. Again, I'm gonna go over this relatively quickly in this video, really just to see if people are even interested in this discussion. And then if so, I can go further into detail. Um, so to start off, what we did is we just downloaded just some SPX moves. So this is from, as you can see, I took data from January 2006 all the way until Monday. And what I did, let's kind of start over in this block. So what you can see is this again is just the time frame that I took a look at. The average 1 day change, meaning from Monday to Tuesday, Tuesday to Wednesday, Wednesday to Thursday, Thursday to Friday, that sort of thing. And the reason why I went with that is just because a lot of the ways that this trade would be deployed would be one DTE. It's not That's not a perfect comparison. There's definitely some shortfalls in terms of being very strict with the expirations that I picked, but I wanted to look at a large data set, so this was the easiest way for me to synthesize that information. The other downside to the way that I have this data set up is um, you'll kind of see it in a minute. So, anyways, the average 1 day change, so 3,955 occurrences, meaning the daily change between each of those trading days was 0.02%. So it means that over this large data source, the majority day in, day out, not a lot of change between each day. Now, the number of positive 1 day changes is 2214. So that means that 56% of the data means that from Monday to Tuesday, that's a positive day, positive change between those 2 days. And the average between the positive side of the data is 0.68%. And then the negatives is 1739 occurrences, which comes out to about 44%. And the average negative day was negative 0.81%. And then just for grins and giggles, I took a look at just the max and min. Max change was 9.64%. Again, not over the week, just from 1 day to the next day. And then the min was minus 9.6. So about the same top side, downside, which is overall interesting, I think. But um, more importantly, we're concerned, and you'll see with most of the stuff that we're going to talk about is to the negative. And the reason for that is that's where all the risk is in this strategy. We already know where max profit is. All right. So let's take a look at the 5 delta. So they talked about doing the 5, 6, and 7. I just did the 5 and 7 to give you an idea of what these look like. And then you can kind of postulate that 6% is somewhere in the middle. We took a look at 500 trades with the original probability assigned. So for this sense, we just use that 5 delta, saying that there's a 5% probability of that being in the money, just as a proxy, which we'll get into the actuals down here. It's pretty damn close. So that gave us 472 winning trades, 28 losing trades. Our average win was $90. Again, I got rid of their $70 max profit potential because that just kills the strategy. The reason why it kills the strategy is because you have a 70% max profit that you take the trade off, then you're immediately entering another trade. So you still carry that same market exposure, but you're not maximizing the profit on each one of those exposures. And in this kind of strategy, that's an important thing to keep in mind how you choose to handle that exposure. So we walked out with a 94% win probability, a little, just a little lower than this. Overall, pretty damn close. And then the average win, again, $90, which was just the credit that I took when I looked at this today. So this average win amount absolutely will change based on IV environments. 100% recognize that that's another shortfall of the way that I just did this quick study. But what I will say is that the average win and average loss would kind of move commensurately. So if we have a really low implied volatility environment, the average win would go down, but so would the average loss and vice versa. So all in all, I think that it still maintains general efficacy for a discussion about the strategy, not necessarily a precise analysis of it. Average loss was $5,199. That's important to keep in mind. That is the kryptonite of these really high probability trades. Is you get tons and tons and tons of base hits, but you don't get anywhere. You need to get somebody actually across home plate. And the issue is with these losses, the way that they're structured in these style strategies is they kill you. So, what does this look like? Over 500 trades executed. The overall gross profit from those is about $42,500. The average loss or the overall loss is about $144,500. So P&L, we're in the red, a little over 100K. Now, let's get into a couple additional pieces of detail. First part, the break even as of today on the 5 delta strategy is 43.74. So if we, I'll pull up the platform in just a second, but what that means is that's a minus 1.7% move in the SPX. So all I did was take a look at the number of occurrences out of this data set that had a loss that was greater than 1.69%, which would be break even. And that came out to be, again, the numbers just about line up 5.56%. It's exactly what you would expect to see here. But this is the important part is the average loss once we hit our loss zone. The average down move was minus 2.85%. So what that means is our average loss came out to be about 5,200 bucks. That's a killer. Now the other thing to keep in mind is I didn't even get into the black swan occurrence. So this strategy would perform far worse still if I included outliers because here's the deal. With a short put, the outlier to the upside, right? So this 9.64% move to the upside, that's a great move to the upside. Guess what? For a credit trade, it doesn't fucking matter. You already received max profit. So realistically, that 9.64% move to the upside is doing nothing to offset your undefined risk to the downside, which is 100% exposed to this move. So in this instance, if the market, again, at the time of looking at this, moved down, that max 1-day down move that I calculated out of here, that 9.54%, and we took that loss to expiration, we'd be walking less $35,000, which again, it happened in that time frame. So the summary there is outliers kill this strategy and reducing your max profit hurts the strategy and not having some sort of process to determine when to enter. That's the biggest issue. This is still a directional trade. This is not something that you can just put on all the time and set it and forget it, and that's it, you're good. Unfortunately, it would be great if that was the case, but there's a reason why it's not the case. And there's a reason why more people don't employ this. Now, the last thing I will say about this strategy that's ultra misleading is it's a great win percentage. A lot of people like that. But I just did a video recently on expectancy, balancing risk and reward. And I mean, this is the topic of the conversation right here. You can have something that literally wins 472 out of 500 trades and you still lose. It's important to keep that in mind when we're formulating a strategy. Don't let a really high win rate mislead you. So, very, very quickly, taking a look at the 7 delta version of this strategy, it does not fare any better. So, what happens in this scenario is the percent move in SPX to find your way into a loss happens a little sooner. And the big issue that you find with this is the number of losses that occur in that zone increase. Um, Overall, it just it doesn't fare better. These have specific environments that they do well in. High implied volatility markets tend to do better with these kind of strategies. Also, I mean, avoiding the market when it's in a clear downtrend. That's another really important part to be successful in these strategies. Because again, if we're just being mechanical every Monday, Wednesday, Friday, whatever cycle you're on, you're deploying these. The issue is if the market has a downtrend that goes for, a week straight. We just saw this fairly recently in the rut. Well, if you put on 3 of these, you have all 3 losers that are larger than your average loss, then you've just wiped out 60 to 80% of your, potential profits depending on how long you've been deploying the strategy in a very short period of time. So, what does this all sum up to? Expectancy. These don't have good expectancy. If you take a look, we're definitely below a 1 on actual expectancy. Shorthand expectancy is negative. So all in all, the strategy, it just doesn't perform. And it's super, super important to take a look at these strategies and the conditions that you want to deploy them in. It's not as simple as set up something with some random numbers assigned to it and you'll be good. The last note I will say is the person that's been deploying this based on their paper, they started this late last year. It's not a great time, right? Because they're getting a lot of positive confirmation bias on it because the market's been really accommodating. But again, in the long haul, these kinds of strategies suffer, especially when they don't have specific circumstances that they're deployed in. So the summary here is it's not to say that this strategy is not viable. The strategy as written is not viable. But if you modify the strategy, create some different controls, both profit loss side potentially, to try to limit this black swan risk is important. But then also making sure that you're developing specific market conditions that you choose to deploy the strategy. That's what this needs. Because if you're just thinking of taking winners down at 70%, which would make this even worse. And the reason why it makes it worse is the profit on really small credit trades is important. Every piece of that profit's important. So it would absolutely increase the overall probability of win slightly, not much. It's already a very high probability strategy. An extra even 2% is not going to fix this. It's the downside risk that's killing this strategy. And that will continue to be the case until either some controls are applied or market conditions are set that this is deployed in. So all in all, I know this one was a little heavier. I'm sorry for kind of diving into some of those details, but I felt like it was important to have the conversation about the strategy. I'm happy to do a follow up video because I've done some Monte Carlo simulations with this stuff. I've done a bunch of back testing with it. This is like literally just the simplest representation I can think of for this venue. But if folks are interested, I'm happy to do a video with some of those more in depth reviews. Um, and I think that about wraps it up. As always, if there's any questions, let me know. Not everything is as good as it seems. Don't follow the pack, but don't ignore the pack either. It's important to keep in mind what everybody's doing and why, but go your own way. All right, I'll catch you all later.